Hi, everybody. Thanks for joining today on this FinCEN Real Estate Reporting seminar. I am Colleen Balderson, and I am going to be going over this. So I'm licensed in Kentucky and Indiana, but the thing about FinCEN is that it is a federal regulation, so it actually applies across all 50 states. So there shouldn't be any real difference in how it is reported. It's kind of like when you report a sale of a closing from the IRS, everybody's got the same federal regulations, and that is across the board. So everything I say today, as far as I know, is valid for all 50 states. And I do want to say that one of the things about what we have going on with all this stuff is that we there is a lot of things that we just don't know yet. So I'm going to give this little disclosure, and because I'm a lawyer and I got to cover myself, um, this is this doesn't constitute legal advice, and this does not create an attorney-client relationship. With these regulations and all things that are brand spanking new, we don't know how exactly it will play out, and if there are things that are going to change, or if there are things that will be scaled back, enhanced, and how it's all going to happen. Because the big thing about this is this all goes down March 1st. So, started doing this March 1st, and this is one of those things that as things get implemented, more will be revealed. And I anticipate, if I was a betting person, which I'm not, just went to Vegas and didn't spend a dime on betting, but if I was a betting person, I would say that they are probably going to ease up some of these restrictions, because it's just going to be virtually impossible to keep up with it. But it's what we know now, so this is what we're going to do. So in this webinar, we're going to talk about what FinCEN is, which closings it pertains to, what info is going to be required, the costs that are going to be and who's going to pay them on each closing, and then what the penalties are. So there are jail time penalties. So I can assure you that we're going to try to do our best to get it done right. So what is FinCEN? FinCEN Real Estate Reporting. So FinCEN is the Financial Crimes Enforcement Network. FinCEN is the shortened version. And there is a reporting for beneficial ownership that was required, and they've actually scaled back on that. So we're not talking about that. So if you own an LLC, there are requirements for some people to file stating who are the owners of those LLCs, socials, all this kind of stuff. It was going to be that everybody that owned an LLC across the board in the United States had to file this. They have since scaled that back, and it's only foreign entities that have to sell to disclose this information. So if you are someone who owns, if you are an LLC that is formed outside the United States, but you're doing business in the United States, they want to know who you are, so you have to give them that information. This is all in an effort to, all of these things are in an effort to stop money laundering. So with this new one, this is about real estate closing. It is only about real estate closings, real estate transactions, not necessarily closings, but transactions, transfer of title of real property. That's what we're talking about here when we're talking about these March 1st implementations and for the real estate reporting. We don't care if you sell, anything, whatever, except if it has to do with real estate, that's what we're talking about here, because there is a lot of money laundering in real estate nationwide. The FinCEN's been tracking some of this stuff for quite some time. It's only recently that they've broadened the scope of everyone that has to report it in all transactions under this little umbrella. So actually quite a large umbrella, but FinCEN's not new to trying to stop money laundering. It's under the Department of Treasury. So just, keep that in mind. This isn't their first rodeo, but it is their first rodeo to this extent. So this is everybody that needs to be reporting, and we are only concerned with who the buyer is. Okay. We might need information on the seller, but the only triggering event depends on who the buyer is. So it's got to be residential property. Even if it's, my understanding is, even if it's just a loft on a piece of commercial property, if someone can live there, that qualifies. What is different about this and other things that we talk about with RESPA and whatnot with residential property, they're, for RESPA, vacant land doesn't count. But for if there's an intention to build a property that will be residential 1 to 4 units on any kind of vacant land, that qualifies. If it's a huge farm that exceeds the scope of RESPA, that sometimes you can think of those things as like, yeah, this goes together, so therefore it would be reported, but not in this case. This is a lot broader reaching than those requirements, so a lot more things will fall into place there. On one hand, but then on other hands, maybe not. Don't you just love that? Okay, so it does matter who the buyer is. So this only applies if it's an LLC, a corporation, a partnership, a trust, an entity of any sort. Okay, there are all kinds of different entities that can own real estate. These are the ones that we're going to be talking about usually. Like that's who comes through my office. So you might qualify, or you might have clients that qualify on all different levels, but that's who we see. So that's kind of what I'm paring it down to just to make this a little bit more digestible. And not every transaction involving these guys. Only transactions that don't use traditional banking for a mortgage. So if it's cash, if it is private financing, if it's a hard money lender, seller financing, all of those things, and being an entity will trigger having to get this information. So yeah, that's who it is. So an LLC, so if you transfer to an LLC or a corporation, even if there's no money changing hands. So let's say you purchased a piece of property by yourself individually, and then 2 years later, you decide you're going to move out, you're going to buy something new, you're going to rent it, and you're going to put it into your LLC. That is a triggering event. There's not a traditional lender involved. There was back in the day, but not anymore. And that LLC, even if there's $0 changing hands, that would need to be reported. This is where I think a lot of attorneys that don't know about this, that aren't in the world of real estate and closings and getting inundated with these continuing educations that we are on the title side, there's going to be a lot of transfers that innocently people don't know qualifies. So that's where I think a lot of this stuff's going to come into place. This makes it a little trickier. So consideration doesn't matter, and it is going to result for the borrower in additional fees. So if you do a quick claim deed, you might be talking about an additional $250, $300 just to get that transferred over to your LLC. LLCs and corporations are pretty helpful when you have, as far as liability protection. So probably worth it, but it is something that people are going to have to think about. So that is something to think about. If you transfer from one LLC to another, people do that all the time. It's gonna get more expensive to do that. So these are the exempt entity and the exempt entities. So transferees, so that's the buyer, that is not a reportable entity. So if it's an individual, you never have to report it on an individual because they figure we can find their social. People are harder to hide. So we don't need to report it ever if it is a buyer who is an individual or a couple or 5 individuals that are buying a property. But as soon as you can't tell exactly who those owners are with like an LLC or something like that, that's where that triggers. Transfer is a result of a divorce or dissolution, result of probate transfer involving a third-party financing, not involving third-party financing. So let's say that you're purchasing from I guess an LLC, you're purchasing from a piece of real estate you inherited, that would probably be exempt. Those are those things that are going to need a little bit more ironing out because some of that stuff, it's like, well, wait a second, is this the way it would be? We have a flow chart and everything, but we can email that to you guys if you want it. A transfer from an individual, not a reportable person, to their trust for no consideration, no money, if it's for estate planning purposes. So we do a lot of estate planning here as well. And anytime somebody has a trust, we suggest that they, almost every time that they go ahead and they transfer that their real estate into the trust. That's part of estate planning purposes. So that's okay. But the people who are the owners, the sellers or transferees, whatever, grantors, they have to be the same people as the ones who are going to end up with it. So I can't transfer to my sister's trust for her estate planning purposes. It's got to be for my own. It's got to be the same ownership. Transfer to a bankruptcy estate or from, and then transfer pursuant to a court order issued in the U.S. So if a court says to do it, then I think you're okay. Probably because they don't want like commissioner sales and stuff like that. They don't want to put the onerous on the courts. That's just my guess. Okay, so a trust. So if an individual purchases real estate without financing, then the transfer and then they transfer it to their trust for estate planning purposes. There's no reporting. But if the trust purchases it first, so I got third-party seller over here, and they're selling it to me, and I'm just going to go ahead and put it in my trust, then I'm going to have to pay for reporting fees, which is cheaper. I don't know. In one instance, you're purchasing it as an individual, and then you got to pay for deed prep and recording to get it in your trust. The other is you purchase it outright in the trust, and then you don't have to pay for a deed later to transfer to the trust, but you're also going to pay for reporting. It's probably going to be a wash. So that's just something to think about, that the workarounds aren't going to really probably save that much money in the long runs. So what info is needed? This information has to get to the title companies prior to closing. So in most instances, everyone who I've spoken to, closings will not get scheduled if we are still waiting on this information. So it is imperative that these clients know that they need it. It is hard enough to even get an EIN number, a tax ID of an LLC, let alone the socials of every owner of the company, their addresses, birth dates, all kinds of stuff. So please, if you have someone who is going to be purchasing a home in a trust or purchasing a home in an LLC and they're not getting any kind of conventional financing, not just conventional, it's certain lenders are approved. But if it's just hard money lending, they're not, that's not exempt. We gotta report it. Please let them know that we're going to need some information, because we won't be scheduling closings where we're missing this, because the penalties are too high, the liability is too high, and I'm not going to jail over it. On the flip side, if you have a seller who is someone who is not real savvy or quick with, getting that information over, we can't close. If they're selling it to somebody who meets those requirements, they will have to provide some information, and we can't schedule it on their end. Sometimes we can't even get people's payoff information. So I can't imagine that they're going to be real gung-ho of giving us even more than that. So please make sure that they know that's not, nobody's trying to scam them or anything. It's just what it is. So it's just going to be the reality. And I don't think you can find a different title company down the street that's going to, go ahead and close without it, because they probably won't be in business for a while, because it's going to be really hefty fines. Okay, so how is the info collected? There's a couple different ways you can do it. So there's one option where the settlement provider, the escrow title company, is going to get the information themselves, and then they're going to upload it into their own portal and report it that way. There are other ones where they will be paying another company to obtain that information. That gets some of the liability off. It is, it's either that they're going to get a link and do it that way. If they're not computer savvy, then they're going to have to probably be on the phone with these guys. So as long as your clients know what is required of them, it could take 5 minutes to give that information. But the closing won't happen unless it's there. So that just keep that in mind. Either way, if you're working with a title company that's going to collect it themselves, or they're going to hire a different company to do it for them, it's going to end up costing about the same money, because it's either a lot of hours on the title company side for their internal people to do it, taking them away from other things, or having to hire new people, or paying for a new software system. So here are the things that you will need. So for an LLC, corporation, or partnership, you need the legal entity's name, the address, jurisdiction where it's formed, the EIN number. Anyone who has 25% ownership or more has to provide their socials, their birth dates, their home addresses. If there's more than that, like, so let's say you have 5 people that are owners, that's 20% each. Whoever is going to be signing is considered to have the substantial control and decision-making authority. So we will need their information. So just keep that in mind. Sometimes it's very difficult to just get two partners to, two LLC members to sign a corporate resolution. So it's going to be a lot of fun to try to get them to fill this stuff out. If another company owns part of it, so you have it, let's say you have an LLC and then it's owned by another LLC or a trust, then we will need that corresponding information for that other entity as well, and down the line. So keep that in mind. If there's multiple trusts or multiple LLCs that own other companies, that's going to, same thing. So the trust buyer, if the buyer is a trust, you're going to need the name of the trust executed, if it's revocable, not revocable, who are all of the trustees, the grantors who can revoke or withdraw assets, beneficiary who can demand money. So the days of just getting a couple pages of a trust are over. We will need the full thing. We will need the whole binder. If a trustee is a company, then we need the identity of the real people behind it. So if you're dealing with Raymond James or Baird or P.S.C, they're going to have to provide us the same information. They will probably be a little bit more versed in what is needed, but just keep that in mind as well. For each individual listed within these entities, legal name, address, their social, government ID image. So we need the IDs of everybody who's got 25% or more owners, or all trustees. And then for the buyer, we need to know how they're paying. So let's say you might have a cash buyer where they disclose that they're getting money out of a P.S.C account. Well, then they show up with a stockyards check. We got to change it all. If they gave an earnest deposit and we find out that that earnest deposit came from a different account, we need to get that information too. So we don't need, right now, I don't think that we need the broker who's holding, we don't need their information. We need the source of the funds that the LLC owner, did they write it to from their individual account? Okay, we need that information. Did mom or dad give it to them? We need their information. So that's where it's going to be, it could be a little bit of last minute changes when we get to closing and we realize this stuff doesn't match. On the seller side, again, sellers don't trigger whether or not you have to report it, but the sellers could be asked for their basic information, taxpayer ID. If they're an LLC, they're going to have to fill out all this stuff too. So just keep that in mind that we will be asking for a lot more. So the costs. Title companies are required. Now we're required. Some of us have to get writers for the liability in this because it can be so high. There is additional software that's required. There's really no standard fee because that would be price fixing, but the fees are likely to range between $200 to $350 on the buyer side. Not locally, but I have heard that nationwide there are some companies that are planning on charging sellers up to $250. So that's really going to be important if you are representing your seller to not get hit with those fines, like a condo association stuff. So they'll probably, I would venture to say that this will be addressed somehow in the standard forms of your local real estate association, but they aren't yet. So not that I know of. So here's some of the language that I would probably put in there. Buyers are going to pay all FinCEN fees. I think that would be a good idea. All contracts that I know of so far from associations are assignable. So you could have an individual that turns out to, they decide that they want to put it in their trust or they're going to open up an LLC. And then suddenly, a seller gets hit with a fee. And you might have someone that does not anticipate that they're going to have to fill out a bunch of stuff. And then the buyer changes how they want to hold title. And now they're putting it in a trust or an LLC or a partnership or corporation. And now the sellers have to fill out stuff. You don't want the sellers to refuse that. So if I was listing agent, I'd be putting buyer to pay all FinCEN fees. If I was the buyer's agent, I would put seller will comply with all FinCEN reporting requirements across the board. Because you may think that you know this, but it may be like, oh, wait, in that exception, now they just added this. I would do it all the time. That I would every single time I have a contract, whether or not I think it applies, because we do see a lot of people who sign contracts as individuals, and then they decide that they want to put it in an LLC or a trust or something like that. So it's important to know what you're going to have to do to get to closing. So this is a new requirement, so have patience, please. I know that there's been a lot as this thing has rolled out. We have had so many updates and so many conflicting things. This is going to apply now. This is going to apply. And we have to do this. No, we don't have to do that. So just, keep, everybody's trying their best. So stay patient and just know that this is something that things are going to get ironed out. It'll just end up being normal day a couple of years from now. But for now, it is going to be a little bit of a learning curve. And most of it is going to be that the buyer and the sellers just have to get us that information. And they're not going to be happy about the additional fees, I'm quite sure. But reach out to us. We would love to help clarify anything for you as far as this webinar goes. If you do have questions, please let me know. We don't have time to answer those right now, but I will reach out to you individually and answer any of those things that are specific to your situation. We are always here to help, to talk to you about things. If you think that you're going to have to, your buyer's thinking about doing this, or they're going to have to do all this stuff, we'll let you know. We can let you know before you even write the contract. So, but that kind of stuff is important because you don't want to be think that something's going to be super easy and then, oh, wait a second, now we need all this stuff. So thanks for listening, and we hope to see you at a closing table soon, and I hope that this cleared some stuff up. Thanks a lot.